The India's hospital stocks have been some of the hottest performance in the market. The Apollo hospitals, it is up by 19% CAGR over 10 years. Fortis Healthcare, it is up by 53% of the CAGR in last 3 years. And the Narayana Hrudayalaya, the ROE is almost 25%. Sounds like it's a no-brainer sector, right? But here is the catch. Apollo is trading 60 times earnings. Fortis, it is at nearly 70 times. Max Healthcare, it is at 67 times. That is not cheap. That is praised for perfection. So today I'm going to compare 4 biggest hospitals in India: Apollo, Max Healthcare, Fortis and Narayana Hrudayalaya. This is for pure as a value investor. Not which stock will go up, but am I paying for the right price for what I'm getting? Without wasting any time, we can quickly get into the video. Before that, if you are new to my channel, please do subscribe it and please do hit like button. Let's go. Let's start with what exactly they are doing. Apollo Hospitals. This is India's largest private hospital chain. They have 73 hospitals, 10,200 plus beds. They also runs Apollo Pharmaceuticals and Diagnostics. It is becoming an full healthcare ecosystems, not just hospitals. The healthcare service is just only 50% of the revenue. Their pharmacy and the digital healthcare growing fast. Let's see what Max Healthcare doing. It is India's largest hospital chain by market cap, second largest by revenue and EBITDA. It is concentrated mainly on North India, Delhi and NCR. It is their core market. Recently acquiring Kalinga hospitals in Odisha and they are expanding in East India. Fortis Healthcare, second largest integrated player. They have hospitals plus SRL diagnostics, 36 facilities, around 4,000 beds, plus they have their presence in Nepal, Dubai and Sri Lanka. The majority is owned by IHH Healthcare. It is an Malaysian healthcare giant. This matters most. I will explain why in a minute. Narayana Hrudayalaya, it is built on affordable healthcare at scale model. 18 hospitals in India plus 2 hospitals in Cayman Island. Yes, it is in Cayman Island. Cayman business is an higher margin and it's a dollar revenue. It is a genuine differentiator from other 3. The common theme across all 4, the hospital demands in India, it is structurally growing. Rising income, healthcare penetrations, medical tourism and aging populations. This is real durable demand story and it is not at one-time spike. Let's see the fundamentals. So we need to understand the revenue and the profit growth. It is genuine or not. Let's understand. When you look at for the Apollo, their revenue, it grew from 14,663 crores in financial year of 22 to 21,794 crores in financial year of 25 and further to 24,215 crores in financial year of 26. This is like time to the market. When you look at their profit, it grew from 1,108 crores to 1,505 crores and now it is 1,866 crores. I mean like financial year of 26 and this is something like time to the market. This is consistent, not an one-time spike. When you look at the last quarter in Q3 financial year of 26, their sales is literally 6,477 crores and the net profit is 516 crores. Both are at new highs. Let's see Max Healthcare. The revenue, it is more than doubled from 3,937 crores to 8,140 crores on financial year of 26. This is like same as like time to the market basis. The profit, it grew similarly, but pay attention. This is helped heavily by acquisition, not just an organic growth. When you look at Q3 financial year of 26 alone, it is like 2,068 crores sales and 301 crore of profit. Let's talk about the Fortis. The revenue, it grew steadily from 5,718 crores to 8,770 crores in financial year of 26. This is like time to the market basis. The profit growth, it looks strongest at 70% of the CAGR over 5 years. But remember, it is growing off a low and troubled base. When you look at the Q3 financial year of 26 alone, they had a sales of 2,265 crores and the profit is 197 crores. Now let's talk about the Narayana. Their revenue, it grew from 3,701 crore to 6,778 crores on financial year of 26. This is like TTM basis. And the profit growth, it slowed sharply. In financial year of 26, the growth is just 6% versus 43% over 5 years. And here is the fresh flag. In Q3 financial year of 26 alone, the net profit, it nearly halved quarter on quarter, dropping to 127 crores from 258 crores in Q2 financial year of 26, with operating margin compression from 24% to 17%. That is worth watching closely on the next quarter. Let's talk about the ROE and ROCE. Who is actually earning well on the capital? Let's start with Narayana. ROCE is 21%, ROE is 24%, This is best in this group. We have to hands down. When you look at the Apollo, the ROCE is 17%, ROE is 16%. It is solid and improving over the last 3 years. The Max Healthcare, the ROCE is 15%, ROE is 13%. When you look at the screener, it flags as it is a low ROE company. Okay, what is there in the Fortis? Fortis has ROCE is 12% and ROE is 10%. This is something like weakest of 4 on the capital efficiency. Now let's talk about the cash flow. We have to understand, does the profit converts into the cash or not? Let's start with the Apollo. Their operating cash flow, it grew from 1,696 crores to 2,136 crores. This is strong, consistent, and I see it is a real cash generation. When you look at the Fortis, their operating cash flow is 97% of operating profit. Looks like it is very healthy conversions. When you look at the Narayana, their operating cash flow, it dipped slightly in financial year of 25 versus 24. This is something we need to watch. It is not at a red flag. Let's understand for the Max Healthcare. Their operating cash flow, it is strongest at 1,459 crores, but the screener, it flags as caution. The company, it might be capitalizing on the interest cost. That is something needs to watch closely. Okay, let's see the promoter integrity. We can start with the Apollo. The promoter holding is 28%. I don't see any major governance issue. It's a clean track record. What is there in the Max Healthcare? The promoter holding is 23.7%. It is completely run by professionally. It is backed by KKR and Abe Soy. I don't see any fraud history on this. Okay, what is there in the Narayana? The promoter holding is 63%. Higher promoter skin in the game. It is founded by Dr. Devi Sethi. It has a clean reputation. Let's talk about the Fortis. This one needs an honest call out. Their original promoters are the Singh brothers. They found guilty on financial irregularities, jailed, and they are barred from security markets. That is real and it is documented as a governance failure. The good news is the Fortis, it is completely controlled by IHH Healthcare. It is professionally run on Malaysian operator since 2018. The governance has visibly improved since the takeover, but as a value investor, the history, it doesn't disappear. It is the reason for the extra scrutiny on the current numbers. Okay, let's understand the debt is under control or not. We can start with the Apollo. Their borrowing, it grew from 4,068 crores to 7,987 crores in just 3 years. Their debt is rising mainly to fund expansion. And when you look at the reserve, it is like 9,021 crores. It is something like comfortably cover it. I see it is manageable, but the rising debt, something we need to track. How is Max Healthcare? Their borrowing, it jumped from 689 crores to 3,275 crores. This is just in 2 years. That is something like a sharp rise and driven by acquisitions. When you look at the reserve, they have something like 9,080 crores. Still it covers it, but the pace of debt addition, it is the fastest in this group. Okay, how is the Fortis? Their borrowing, it rose from 926 crores to 3,195 crores. Almost it is rising fast, and the reserves of 8,674 crores, it provides the cushion. How is the Narayana? Their borrowing, it rose from 884 crores to 2,340 crores. This is the smallest absolute the debt load on the four. The reserve they have is 3,855 crores. Okay, my takeaway on debt is none of these fours are in danger territory. When you look at the reserve, it is comfortably covers the borrowing across the board. But all four are adding debt for the expansion and it is not reducing it. As a value investor, this isn't a red flag yet, but it is a trend to track every quarter. The debt fund expansion, it only works if the ROCE stays above the cost of the debt. Okay, let's see the valuation. Am I paying the right amount or not? Let's do the PE comparison. When you look at the Narayana, it has 45x, Apollo, it has 60x, Max Healthcare, it has 68x, the Fortis Healthcare, they have 70x. Your pure play listed hospitals in India, they are broadly trading between 45x to 110x of PE. Even the cheapest of our four, the Narayana, it is at 45x and still it is a rich at traditional value investing standards. Well, I need something like a margin of safety closer to 20 to 25x for a mature business. Okay, let's see the price to book value. Narayana has 9.2x of book value. Max Healthcare, they have 9.8. Fortis, they have 7.4. Apollo, they have 12.1. For a context, the reasonable price to book value for an asset heavy healthcare business, it would typically be in 3 to 5x. All four are trading doubled or tripled that. So what exactly this tells us? The entire hospital sector in India praised for sustained high double-digit growth for years. The market is betting on insurance penetrations, medical tourism, and the bed capacity expansion, all playing out exactly as expected. If one of these assumptions slips, a slowdown in the occupancy, a regulation price cap on the procedures, higher competitions, these multiples will have a very little cushions. The relative value within the group is Narayana has the best ROE and ROCE, lowest PE of 4. This is on pure number basis. It is screened as the most reasonably priced. When you look at the Fortis, it has highest PE and weakest ROE, and it carries the governance history as well. When you look at for Apollo and the Max Healthcare, it sits in between, something like paying for premium of scale and the brand, but at the steep price. Okay, we have come to the final part of the video. What I like across the sector, it is genuine. There is a structural demand, it isn't fade. All four companies, they have showed the real revenue growth backed by the real cash flow, and there is no accounting trick. The debt levels are still covered by the reserves. It is across the board. So what concerns me? The valuations are stretched across the entire sector. There is very little margin of safety anywhere right now. The debt is rising on all four companies, mostly to fund expansion. It is fine for now, but it is worth tracking. The Fortis, it has a real governance scare from its founding promoters. Even with IHHS cleanup since 2018, the history, it demands for extra caution. When you look at for the Max Healthcare, the interest capitalization, it is a flag and it is a fast debt buildup. I would want to watch closely on the next quarter. You look at the Narayana's Q3 financial year of 26, the numbers were soft. Their profit nearly halved sequentially. Their margin is compressed. The one quarter isn't a trend, but it tempers my enthusiasm for the best fundamentals name in this group. Okay, let's do a stock by stock. Here is where I land. I would like to start with Narayana Hrudayalaya. It is best in ROE, ROCE, lowest debt and lowest PE among four. Still, it is not cheap in an absolute terms, but relatively the most reasonable. That said, in Q3 financial year of 26, they showed a sharp sequential profit drop. I would like to see this in next 1 or 2 quarters just to confirm this was a blip but not a trend. I may consider this one for close tracking, waiting for both a better entry price and the confirmation the financial year of 26, the wobble was temporary. Apollo Hospitals. It is strong and consistent fundamental, clean governance, but the valuation is demanding. I will avoid at current price. I'm extremely waiting for the correction. Max Healthcare. It is a good growth story, but the debt is rising. The interest capitalization flags makes me cautious. Combined with 68x PE, I will definitely avoid right now. Fortis Healthcare. It is improving the fundamentals under IHH, but the highest valuation, weakest ROE, and the governance history that demands extra scrutiny. I will avoid until there is more sustained evidence for the clean execution and the price corrects meaningfully. Okay, finally, this sector I am watching closely and not buying right now. It is actually a good business, but the price the market want today doesn't leave the room for error. This is not an investment advice. It is purely my own value investing framework applied to a public data. Always do your own research before making any decisions. If you found this video is helpful, please do hit a like button. We'll see you on another good video. Till then, bye.